Hi, everybody. Welcome to Dividend Stockpile, where we talk about all things dividend and income investing related. We are continuing our interview series where we talk to the best and brightest in the investing world. Today, we are joined by Rob Thummel from Tortoise Capital, the industry experts in energy investing. Rob is a senior portfolio manager, a member of the investment committee, and serves as president of Tortoise Energy Independence Fund, a closed-end fund of theirs. Before joining the firm, he was a director of finance at KLT Incorporated, which is a subsidiary of Great Plains Energy. He's also a senior auditor at Ernst & Young, and he earned his bachelor's in science degree in accounting from Kansas State University and an MBA degree from University of Kansas. Rob is a frequent energy sector contributor on different financial media, including Bloomberg, CNBC, Fox Business, and Wall Street Journal. Tortoise Capital offers mutual funds, closed-end funds, ETFs, separately managed accounts, and an interval fund focused on the energy market. In today's discussion, we are going to talk about two of their funds, the Tortoise Energy Infrastructure Corp, ticker TYG, and Tortoise Essential Energy Fund, ticker TPZ. Before we get to all that, welcome, Rob.
Thanks for having me, Jeremy.
So excited to talk to you. I've been a big fan of Tortoise for a very long time, and so I'm glad we were able to connect to talk about some of your great funds. So as we get started, can you give us a little bit of background on Tortoise Capital?
Yeah, so Tortoise has been around a long time, over 20 years. So Tortoise actually was started in the .com era, basically. When, if you remember the .com era, everything was asset light strategies, basically, and everybody wanted asset light. And in the meantime, Tortoise saw a huge opportunity here for asset heavy, physical infrastructure assets, right? If you think about energy is the lifeblood of the economy. Energy infrastructure sector is kind of like the capillaries, basically, of your body, carrying these energy products and like the nutrients in your body to exactly where they're needed to go. And so the team at Tortoise started Tortoise 20 years ago because these assets were underappreciated. And undervalued, obviously, and they offered really high dividends at the time, and still do pay high dividends, and so that's what really started Tortoise. And then clearly, the biggest opportunity for the energy sector has been the development of U.S. shale. Right, the U.S. shale evolution really has been probably the biggest. Definitely in the energy sector, one of the biggest technology and the impact of shale has been one of the biggest the biggest technology events, basically, really in my investing lifetime of over 30 years. And so that really created, a second wave of opportunity for us at Tortoise, because the U.S. Because of U.S. shale really became the largest energy producer in the world, and then the largest exporter in the world, and that just created significant opportunities for many of the companies we're investing in. So today, obviously, there have been some ups and downs, and we can talk about those in the energy sector. That's part of it. But energy infrastructure, the thing about energy infrastructure, it does provide some certainty in uncertain times, and the reason for that is because of the dividends that the energy infrastructure pays, and the fact that energy infrastructure cash flows are more fee-based, annual recurring revenue type of models, less commodity sensitive. So as long as the economy continues to increase, and by the way, the global energy demand has increased 40 out of the last 42 years. As long as that continues, energy infrastructure, we think, will continue to deliver really strong returns for investors.
And so energy can encompass a bunch of different subcategories within energy. Are there certain parts that you're most involved in? Is it the midstream energy companies? Is it the production? Is it the search and find for new oil fields? Where does Tortoise really focus their energy at?
Yeah, so at Tortoise, we look at the entire energy sector. That's what we've done for 20 years, over 20 years, basically, and myself personally over 30 years. But where a lot of our products are, and some of the ones that we're going to talk about today, are more focused on the infrastructure, on energy infrastructure, whether it's pipelines, these long haul pipelines that obviously have been around, or that are absolutely necessary, that are absolutely essential, that the role that the pipelines provide are, as I mentioned earlier, they kind of serve like your capillaries in your circulatory system, basically taking the energy, or in the case of your body, taking your blood and taking the nutrients and the oxygen and getting it to the right places to make sure that the economies function just like your body functions. And so that's what the role that they provide. Also, electric, an area that we've obviously seen significant growth in demand for now going forward because of AI is electricity generation. A lot of electricity generation growth. We can talk about that in a second, but we're just beginning the age of electricity, which is really important because the last 20 years you've had no electricity increases in electricity demand. Zero. It's been about 4,000 terawatt hours basically on average for the last 20 years. We're getting ready to just start this age of electricity that we're going to see growth in electricity demand for the first time in the last couple of decades. That's a significant opportunity that we see for investors and for our funds and investment opportunities.
Yeah, so the current funds you have right now are open to electric as well as the energy production and transport.
That's exactly right, Jeremy. They can invest across all of those sectors.
Okay, yeah, with the AI boom and the enhanced need for more energy, electrical companies are definitely the hot item right now. So
Yeah.
it's great to be able to ride that wave up, because I totally agree with the AI and all the other things we have going on. I mean, everything we have is connected to the internet and different things, so we're using a lot more energy. And to your point, the power plants and the power companies need to spend billions of dollars over the next few years to really ramp up that ability to cover all these resources that are going to be pulling from the system. So it's a great opportunity for energy going forward. And that's one of the reasons why I wanted to bring you on, is because there is such a demand and such a need for new energy. With your guys' background and your company's background in the energy sector, I thought it was a really timely point to talk through some of your products.
Yeah, and don't forget, obviously, just to add to that, Jeremy, so you're exactly right. I agree with you 100%. Also, if we're going to bring back more manufacturing to the U.S. and advanced manufacturing, that's going to require more energy and reliable, consistent energy that's available, and electricity that's available 7 days a week, 24 hours a day, 365 days a year. That's the type of thing that natural gas can do, and that's why we think that going forward, the energy sector is really evolving. And going forward, we think that natural gas will play a really, really important role in the global energy sector, but especially in the U.S. Natural gas is already the largest energy supply source to generate electricity in the U.S., but we think the energy sector will be redefined. Natural gas will now begin taking the lead and will be the growth driver and the growth engine for the energy sector going forward.
Yeah, the nice thing I like about the pipeline companies is it really is a toll road for energy development. No matter what the price of oil is or the price of gas or anything else, they still pay to sit in through the pipelines. And so those companies are pretty much like the railroads of the energy movement. So they're going to get paid no matter if their price of oil is 100 or if it's 50 or if it's 25, they still get paid. So that's a nice business to be in. And I'm sure that's why they're able to provide those consistent income streams like you've been talking about.
You're exactly right. And I think that's a really important point that you just made with regards to the companies. And that's why I say in uncertain times, economic times that we're living in now, there is certainty, we believe, in these dividends because of the reasons that you just articulated very well, because of the contract structure, effectively, and all the reasons that you mentioned. That we would agree with you 100% on that.
Yeah, so we're going to dig into some of the companies that your funds hold right now. But what's your company's view or your personal view on the renewable energy sector? Because I know that's gotten a lot of attention over the last couple of years, especially under the Biden administration. But now that Trump's administration is here, he's kind of wishy-washy on that. Where do you see renewable energy infrastructure kind of fit into the other models of energy that you have right now?
Yeah, so the way we look at renewable energy, or look at the energy sector in general, look, for the economy, for global economic growth to continue to expand, for the global economy to prosper, and also, oh, by the way, there's a bunch of people that still live in energy poverty, and not in the U.S., but in other areas of the world. And we believe that over time that there will be opportunities for those people to experience a quality of life because of low cost energy, and especially coming from the U.S. That's probably hopefully unlike what they've experienced before. All of those factors will lead. We just need more energy, and so our view is an all of the above approach. Now, we still do believe that right now, oil and gas will be the primary drivers of global energy going forward. Oil and gas and coal and other basically fossil fuels have represented over 80% of the energy supply really over the last several decades, probably the last 30, 40 years, actually longer than that, 50 years. Oil and gas probably still, natural gas and oil probably still maintain that dominance going forward for an extended period of time. But we watch all of these emerging energy technologies at Tortoise very closely, and have the ability, should one of these emerging technologies evolve, to become economic and provide economic, reliable, steady, consistent energy, then it's an area that we're interested in, and could tilt the portfolio. It's no different than what happened with what we did with natural gas, because if you go back and look, and some people forget about this, and I understand why, because you don't study it like I do every day for 30 years. But look at carbon emissions in the U.S.
Mm-hmm.
Not a lot of people remember or know that carbon emissions in the U.S. have actually declined in the last 20 years. Why? Well, it's because of U.S. shale technology unlocking new forms of energy, of oil and gas. And so what's happened with that allowed is cheap natural gas in the U.S. has been able to replace coal. Because coal is much dirtier and generates a lot more carbon emissions than natural gas. In the last 20 years, natural gas has surged to represent the largest energy supply source of electricity in the U.S. Coal has declined because of more natural gas, less coal. Well, the net result, lower carbon emissions. And so natural gas by itself can be decarbonizing, which is effectively the goal of renewable energy.
Yeah, for sure. Natural gas is definitely the what we call it, like the middleman, or like the step from the super dirty energy sources to a future of renewable sources like wind, solar, and battery storage. But until those are up and running, as well as having the backup power to provide energy when the sun's not shining and the wind is not blowing, we need to have some infrastructure in place. And natural gas is a good way to supplement that, because it is on demand and it's readily available. And we're probably going to need that going forward, even if we are primarily renewable energy in the future. Personally, besides my ETFs, I only invest in renewable energy sources. I noticed in one of your funds, you guys have Clearway Energy, CWEN. That's one of my favorite renewable energy. Are there any other renewable energy companies that you see up and coming that are of interest?
Well, at the present time, CWEN is probably our primary holding in that fund, and obviously that's a solar and wind operator that pays a nice dividend and has a good management team and has some really good assets on the solar and wind side. You know what? We are looking at watching closely the development in the things like battery storage that you mentioned. But we don't feel like that's gotten to commercial scale yet, and so that's that we watch. We look at the development of hydrogen. That still is not yet a commercial phase. A lot of people ask us about small modular nuclear reactors, maybe not necessarily renewable, but clean. We follow those very closely, and I think it's important for everyone to understand that those have potential. It's just going to be a little ways away yet. Those still require a lot of research and development because it's a new technology. It's not the same technology that existing nuclear reactors are utilizing. And so it requires a lot of research and development still to be determined commercial. So we watch them very closely, but we still think that those are 2030 and beyond. So we're looking at all these new technologies, like I said, have the ability to pivot if and when we see one of these technologies is going to be scalable, generate commercial and is commercial, and more importantly, can provide the steady dividends that we're talking about here, right? That's what we're talking about. Obviously that's what you like, and probably a lot of the listeners to this show want steady dividend income, and that's what we want to provide to shareholders. And so when some of the renewable energy technology reach that type of scale and meet those criteria, then obviously we'll have the ability to invest.
Yeah, that's actually a good reminder. So that one of the primary focuses of the funds you offer is that monthly income from the production of and transport of oil. So if these new technologies are great, but they're still reinvesting all their earnings back into growing or R&D and stuff like that, they're not going to be paying out the dividends that you get from more of your legacy players, your pipelines and things like that. So that actually makes a lot of sense. You're keeping your ear out for things, but it's going to take some time for them to get up and running and to a point where their cash flow allows them to pay out dividends and distribution. All right, so let's switch over to the two funds we want to talk about. I want to start with TYG, the Tortoise Energy Infrastructure Corp. So can you give us a little bit of background on that fund, kind of what your focus area is and how the fund operates?
Yeah, so TYG is a closed-end mutual fund. Many of you know probably what that means, so I won't explain too much about that. But it's been around for a long time. It was the initial product out of Tortoise in 2004, I guess is when and it originally was designed to provide investors easy access to MLPs. It was designed as a corporation to own MLPs, and the reason why for that was for tax simplicity's sake. Provide you a 1099. That fund has evolved over time, though, and today that fund, we just merged a couple funds together, so it's a little larger fund right now, and it's focused more on what we were talking about earlier, which it's focused on energy infrastructure and it's focused on electricity generation. So inside that fund, we own what we think are the very best pipelines, and it's mostly natural gas pipelines that we focus on in the fund from an energy infrastructure perspective. Once again, because natural gas is the largest energy fuel supply source for electric generation, those pipelines are really critical, and we see opportunities with AI for the natural gas infrastructure sector to really grow with more volumes going through the pipelines. On the flip side, electric generation, that, as we mentioned earlier, significant growth opportunities in electric generation. And so we own areas where we expect to see significant growth opportunities. If you think about electric generation, what we're going to need in the U.S., it's really remarkable. We're going to need 1,000 terawatt hours of new electricity generation between now and 2030. You say, well, what does that mean? Let me give you a perspective. How much is 1,000 terawatt hours? Well, 1,000 terawatt hours today is the same amount of retail electricity that's being consumed in the states of California, Texas, Florida, and New York combined. All those, a lot of electricity needed. So these electricity generation companies are going to benefit as well. Included in there is also, we own one of the largest or the largest nuclear power plant providers in the U.S. as well, Constellation Energy, one of our larger holdings as well. So that's what our TYG fund holds, and we pay a dividend, and an elevated dividend there for shareholders. A lot of that we earn. Some of that is a little bit of return of some of that is a return of capital. I think we try to make that fairly clear. It does trade at a discount, a little bit of a discount, 9% discount to its net asset value. So it offers investors an opportunity to invest in some really high quality companies with big economic moats that are assets are impossible to replicate. We think really good management teams, steady income, growth in that income as well. And so that's really what we try to offer in a closed-end fund format. Obviously, as many investors know, when you invest in closed-end funds, we do have a little bit of leverage on there. I think 20% of the fund it's levered up to 20% of the net assets, or of total assets, I mean. So that's characteristic of all of these closed-end funds.
Yeah, definitely. I invest in quite a few closed-end funds, so that's par for the course, if you will. So a little bit about this fund. The asset allocation looks like 57% or so natural gas, 25% or 28% power infrastructure, and then the other remaining is liquids infrastructure. So that gives you a good sense of what are the subsectors within the energy. Top holdings is the Williams Company, Targa Resources, MPLX, ONEOK, I can always mess that one up, and Sempra Energy are the top 5. So, you get a good sense on what the fund is holding as of right now. Looking at the 331, it looked like the distribution was a little over 10%, so I'm assuming it's still in that general range. And what's your management fee? Because closed-end funds typically have a little bit higher management fee than some of your ETFs.
1% or so, maybe just a little bit under that. I think it might be 95 basis points.
But to have that active management and have the ability to use leverage to enhance the returns, less than 1% a year for that expertise that you guys offer in the energy field definitely makes a lot of sense. You guys are spending, all your entire work week and multiple analysts looking at this stuff, as opposed to us individuals not having the time to really do the research to figure out which companies are the best or the up and coming ones. With buying your closed-end fund and paying that administration fee or the management fee, you get a lot of benefit from that. So I think that's very reasonable for what you guys offer.
Yeah, I do think that's important for your listeners to learn, to understand it. I mean, obviously, like I said, I've been investing in the energy sector for 30 years. We've got a team I have 4 portfolio managers at Tortoise, and I'm one of them. We've been working together for over almost 20 years, actually, all of us together. And so we've been through multiple market cycles. Pipelines are created equal. Not all energy is created equal. So it's really important to keep on top of what's going on in the energy sector, where the best opportunities are. Our approach, maybe where we're a little different than our competitors, or just broadly speaking, generalists in nature. We really focus on these high quality cash flows, these large economic moats, these pipelines that are going to be absolutely essential, not just for a year or two, but for decades. And as you highlighted earlier, the contract structures are really important in understanding those. And we've lived through different environments, the financial crisis. 2008. We've managed portfolios through that, through the OPEC Thanksgiving Day surprise of 2014, through COVID 2020, and have access to these management teams as well to all of the time about asset allocation and capital allocation. So that's a little bit of extra that you get, I guess, maybe when you don't have time for yourself, and if you're investing in dividends, I'm hoping you're spending more time, enjoying your life and in retirement or whatever it may be than focused on individual stocks. Let us do that for you.
Yeah, and you've done very well. I'm looking at the performance of this particular fund over the last 5 years, almost 44% return in 5 years. So that's amazing.
Yeah, the sector got beaten up, and there was concern about global energy demand. It was a global a global economic crisis, and there was concern about the long-term duration of these pipelines that we owned and these electricity generation facilities. And you know what? You got to give management the credit. They did a pivot. They did a 180-degree pivot, focused on capital allocation. We really encouraged them to start generating free cash flow starting in 2020. They did. The net result is obviously dividends have been strong. There's been growth in the dividends, and the companies have been able to buy back stock. And that's really the new phenomenon, I guess, in my 30 years, which I haven't seen a lot of, is periods of free cash flow and companies being able to buy back stock. And as a result of the pivot that the companies made, the need for energy infrastructure, and more importantly, just the outlook for energy going forward. And now this catalyst of AI and electricity generation going up, and this age of electricity that will probably become the age of natural gas as well. That is really what's really propelled this sector, and investors have come back. But oh, by the way, all that, and that's great returns. A lot of people ask us, oh, have I missed it? And because the sector, energy infrastructure, is still trading at a discount to what it's traded at historically. And so you're still buying the sector at a discount to what it's been valued at historically. And I think there's an argument to be made that the sector should trade at even a higher enterprise value to EBITDA multiple than it's traded at historically, because of these new catalysts such as AI development.
Yeah, it's definitely going to be an interesting 5 to 10 years as the build out of all these data centers and the AI usage around the world. How much energy demand is really going to have to pick up. And I think you mentioned earlier 1,000 megawatts. That's like 25% more than the US is using right now. So it's absolutely amazing how much extra energy we need to produce. And, a fund like yours will be able to take advantage of that. And because you guys have your finger on the pulse of what's going on in that industry. That's great. And to your point, you can buy it at a discount, and the closed-end fund itself is trading at a discount. So it's like the whole sector is undervalued, plus your fund is undervalued. So it might be a good opportunity to get in for the long run.
I agree with you 100% on that one.
That sounds good. All right, let's move over to your other one that we want to talk about today, and that is the Tortoise Essential Energy Fund, TPZ. So that one's a little bit of a different structure. So can you talk through on that one?
Yes, that's our first foray into the active ETF strategy, and so we just converted TPZ into an active ETF, and we're excited about this one because we know that investor demand is, or investors are looking for ETFs, and they're looking for active ETFs. That has an appeal from a structure perspective for some tax reasons and other reasons, and advisors and investors want that type of a structure, so we created it. It invests in a very similar manner to TYG, focused what we call electrification, basically. If you just think what's going to happen, what's going to drive the energy sector going forward, it's going to be electrification. So as we look forward, a lot of things are being electrified. As we mentioned at the onset of this of this discussion, AI is going to drive that because electricity generation, but also if we're going to bring back a bunch of manufacturing to the U.S., it's going to need electricity. And so that electrification that's going to happen, over the next several decades, this fund's designed to capture that growth and that opportunity, investing in a similar way in infrastructure and natural gas and the natural gas pipelines that are really going to provide the fuel source to generate that electricity, and then the electricity generation, the companies that are generating that electricity on the other side and meeting the customer needs. So so the real difference here, though, is the is the active ETF nature of it. And so that's how we positioned it, and are excited to continue to talk about this fund and get investor feedback as well.
Yeah, absolutely. So just looking at some of the details, it looks like it's a pretty small amount of holdings. I'm looking at about 30 to 31 holdings right now, which is very interesting because when you think of like the entire energy sector, there's definitely a lot more than 31 companies. But by having that active management, you guys can pick what you feel is the best of those instead of investing in the whole sector. Different energy companies have different exposures, different risks. And so being able to have that active management, not just an index, hopefully will give you that alpha that we're all looking for.
Yeah. So the key there, and you're right. Often people look at our holdings and say, "Oh, that's really concentrated," because you're used to investing in a fund with 500. I don't know,
Mm-hmm.
500 holdings. And we understand that at Tortoise, what you have to be comfortable with, or what I want you to get comfortable with, is remember these assets that we're investing in. Remember our approach, our investment process. High quality companies, absolutely critical, absolutely essential, wide economic moats. So what we're trying to do, what we've done, and I think we have a track record and that would show, is we find what we think are the highest quality companies, the best positioned assets, the companies that have a huge competitive advantage because their assets are absolutely critical, absolutely essential. And then we take bigger bets on those. And you know what? We feel good about that because of the essential nature of the assets and the growth profile based on where the assets are located.
Yeah. And with your guys, 20 plus years experience, what works in the industry and what doesn't work. So it definitely makes sense that you guys would take the active approach because, you're going to be able to pick the best of them. A little bit about the fund. It looks like it's a monthly distribution and the yield is a little about 4.5% right now.
Yep, that's right. Right around 4.5%. Yep, that's exactly right.
Yeah, that's a good balance between, getting some current income today, but also, investing in companies that can grow over time. So I was looking on the fact sheet on this one. It looks like you guys might be able to do private or debt financing investing. Is that accurate?
We can. No, we can do a little bit of that if we want to. We don't, we have a little bit of invested in debt securities right now, publicly traded. We don't have a lot invested in private. We have the ability to do that. I'll be honest. In our approach, Jeremy, what we like right now is, the best pipelines, the best electrification resides in publicly traded companies. That the benefit that we have in the U.S. The U.S. has the largest pipeline and energy infrastructure network in the world.
Mm-hmm.
And the great thing about it, it's all, for the most part, available to be invested in through publicly traded investments. And so so we really like the liquidity that offers investors, and frankly, we just like the dividends, the high yields, and the growth opportunities that investing in the largest energy infrastructure network in the world here in the U.S. really provides to our clients, our investors, and your listeners.
Sounds good. And so just a little bit for everyone's awareness, top holdings is MPLX, Targa Resources, Energy Transfer, ONEOK, and Hess Midstream. It also has Enterprise Products Partners and some other energy companies that we're probably all aware of and might even invest on our own in those particular names. So you get the top of the top, and you get a good variety of companies. Even with a smaller total number of companies, you still get a good diversifying ability. Looks like the portfolio allocation, according to your website, is 69% natural gas, 18% liquids, 9% power, and then a tiny bit of solar and wind. So you get a variety of energy sources in this fund as well.
That's exactly right.
It looks like it's a great option. Do you know what the expense ratio on this active ETF is?
I believe it's about 85 basis points.
So again, you guys are putting the work in. You guys are actively looking at it. It's not just an index fund. So it's to be said that it would be a higher expense ratio. But again, what is it? $85 for every $10,000 invested every year. That's really not a lot of money to pay for that industry expertise that you guys have to offer. I know a lot of people look for the lowest expense ratio, but if you look at what you're getting for your money, I'm all about, finding the right fund, no matter what the expense ratio is. And I think you guys, if someone is focused and interested in income from the energy market, your funds are worth paying the administration fee for.
Yeah, I appreciate that, Jeremy, because I do think investors need, and your listeners do need to, when you look at the energy sector, it's big, it's vast, a lot of options out there. And not all energy is created equal, and not all of the cash flows of the companies in the energy sector are created equal. Some have significantly more commodity price exposure, and that's really important to understand, depending on what you're trying to achieve, and your listeners are trying to achieve. But if you're looking for steady, consistent income with some growth to it, the companies we're investing in are the place to be from our perspective.
And that's definitely the focus for myself, is that income generation with a little bit of capital appreciation. And I think a lot of the people who listen to the channel feel the same way. So these are two great resources. So just to wrap up, the one we just talked about was Tortoise Essential Energy Fund, TPZ. And then the other one that we had talked about earlier is the Tortoise Energy Infrastructure Corp, ticker TYG. What do you think is the biggest area of growth over the next 5 years that people can get excited about?
Yeah, it's all this electricity demand. It's two things. It's energy exports and electricity demand. So the largest energy exporter in the world. The U.S. exports many energy products: liquefied natural gas, ethane, propane, oil, refined products, gasoline, diesel, jet fuel, all over the world. We've become the largest the largest energy exporter in the entire world. That's significant. So the world needs more energy, is going to need more energy for the economy to grow, but the world also needs more U.S. energy because of the positive the energy security and the importance of having energy security across the world. We just saw what happened with Europe a couple of years ago. Who came in and helped? That's the U.S. and U.S. LNG. It really saved Europe from what could have been a brutal winter just with energy prices, and that can continue in other areas of the world as well going forward. And so that's what U.S. shales really help and really is, and why the energy sector, I think, is underappreciated, is because the U.S. shale sector has really created this big opportunity for the U.S. to be energy dominant and to provide opportunities going forward. But the other factor is is AI, and desire for the U.S. to have AI dominance. And the only way that you're going to achieve AI dominance, obviously, got to have the technology, and there's a bunch of technology companies out there that are doing a fantastic job of that. But you also need reliable, consistent, steady electricity and energy supply, and you need low cost electricity. That's one of the reasons why the U.S., in Northern Virginia, has more data centers in Northern Virginia than I think 3 or 4 of the country. Some of the largest countries in the world combined, because of the low cost of energy, and that's what the U.S. provides. But that electricity generation and that growth in electricity consumption going forward, as you highlighted earlier, and the magnitude of it is significant, and that opportunity as well for the energy sector and both of the funds that you talked about and the stocks that we're investing in there: energy exports and the development of AI going forward.
Yeah, it just made me think of something. I was reading something the other day where these data center providers are pretty much ready to break ground, but they have to know that they have a reliable source of energy and power to run those data centers. So there's certain locations throughout the United States that they're ending up having to go away from just because there's not an energy source readily available. And so that's going to be a huge driver for all these electrical generation companies, is to provide those new resources and the new sources of energy to run these data centers. I mean, these things gobble up a ton of energy. And so you need to have that reliable source, something that's close by those data centers. So the states and the companies that can provide that are definitely going to benefit from that long-term contracts that are going to get with those data centers to run the AI like you were talking about.
Yeah, you're exactly right. And in some cases, you know what, they're just going to build the data centers, are going to contract directly with the energy pipeline companies and build the electric generation on their own. We've had a couple announcements related to that from Energy Transfer, a potential one from Energy Transfer, and a potential opportunity from Williams, who's one of the holdings as well that you mentioned earlier. That's something to keep for your listeners to keep your eye on if they want to spend time on this topic. But it's going to be. Well, for me, as a 30-year energy industry veteran, it's one of the more exciting times. Shale was really exciting. This is the version 2.0, 3.0. I don't know what version we're on, but it's the next exciting decade and beyond of looking at the opportunities that AI data centers are going to provide. We're really excited.
Yeah. It's funny to think that energy is going to be exciting, but I think to your point, there's a lot of things going on. It's usually not energy that you get excited about. It's the AI and the tech and everything. But again, energy provides the resources to do all these other things. So it's a good time to invest. All right, Rob, let's finish up. Anything else you want to tell the audience about either your company, yourself, or the industry before we end?
No, I don't think so. I know I appreciate everybody's interest in our products, and hopefully I share something with you that you're interested in. You can access us and get a hold of us on our website at the tortoisecapital.com. And if you're interested in talking to me or to one of our fellow portfolio managers or somebody else within our company. So thank you for listening and your interest, and Jeremy, thanks to you for having me on your channel.
Yeah, I absolutely appreciate you coming on, talking about the industry, talking about your expertise, and giving us some ideas of some different funds that we can go research in an energy space. So again, your website is tortoisecapital.com, has all the information you need on all your different funds. We appreciate your time, and we'll talk to you soon, Rob.
Thanks, Jeremy.